Hopefully I have shared my screen properly, but somebody please let me know if I haven't. And thank you very much for the opportunity to, thanks Sinead. Thanks very much for the opportunity to speak to you this afternoon or this morning. It's quite early in the morning here in Dublin, Monday morning. So we're ready to face into a new week. And Sinead and I are here today to talk, I guess, about COVID-19 and climate risks, so two of the more interesting and bigger risks facing us at the moment in the context of the ORSA. I guess most people in the audience are probably likely to be very familiar with the idea of the ORSA and the concept of the ORSA. So I'm just going to spend a couple of minutes, or a few minutes, just sort of introducing the ORSA and for those of you who would be less familiar with it as a concept. And then I'll talk a little bit about COVID-19 and the context of the ORSA. And then I'll pass over to Sinead, who's going to talk a bit about climate risk in the context of the ORSA. So let me start with just I suppose a couple of general comments about the ORSA. ORSA stands for Own Risk and Solvency Assessment, and it really is effectively now a global requirement for insurers. The International Association of Insurance Supervisors, the IAIS, requires an ORSA as part of regulatory regimes under its insurance core principles, so ICP 16. It's called different things in different parts of the world, so the name can vary, but an ORSA is required in many countries across every continent. I've listed some of the countries here on this slide which have ORSA requirements or equivalent, and I note that for many of the countries the ORSA requirement has been in place for 5 years and in many cases for more than that, so it is quite a widespread requirement. I guess I've heard a range of views on the effectiveness of the ORSA and the importance of the ORSA for insurers across really a broad spectrum. So for some insurers, I guess the ORSA is this really cool risk management tool. It's where you take your business plan, you match it to your capital and your liquidity position, you draw in the context of your risk framework and your risk appetite, and you start stressing all the things that could go wrong to try and understand the extent to which you can afford the business plan that you have from a solvency perspective, and to identify the actions you can take to prevent everything from going wrong. So in many respects, then it can become, I guess, the engine to your decision making, helps you to future-proof your business, protect the interests of your shareholders and your policyholders. When Solvency II was being introduced in Europe, the chair of EIOPA is the collective group of European insurance regulators. The chair of EIOPA at the time described the ORSA as the heart of Solvency II, and they really saw it as the piece where the risk components of Solvency II and the sort of quantitative components of Solvency II all came together in one place. So that's one view of the ORSA as a rather wonderful risk management tool. An alternative view of the ORSA that I've seen expressed is that it's a sort of compliance exercise. You do it every year because you have to. You dust down what you did the last time, you update a few numbers, you stress the same things, sales, loss ratios, market returns, something around expenses or inflation assumptions. You do your ORSA, get it out of the way, and then you can go back to the day job of running your insurance company. And I think the truth for many insurers is somewhere in between those two extremes. And I think to use the analogy of the ORSA as being the heart of Solvency II, if the ORSA is the heart of an insurer's risk management system, then as good health actuaries will know that you need some heart-healthy activities. You need to exercise your ORSA well, and you need to feed it the right stuff. So a key driver of our presentation today is to understand how can the ORSA deal with material changes in the business landscape, potential big ticket risks that could have fundamental implications for how insurers operate. And we've chosen two of the most popular topics in the current business environment. So we've chosen COVID-19, obviously, which is very much a hot topic in terms of insurance risk at the moment, and climate risk too, which is, I guess, a hot topic and one with potentially huge implications for the future. And the question, I guess, is what can the ORSA tell an insurer about its exposures to these risks? And then in turn, what can these risks tell us about our ORSAs? So for the next 10 or 15 minutes, I'm going to take a closer look at ORSAs in the context of COVID, and then I'm going to hand over to Sinead, who will look at the challenges of dealing with a longer term risk like climate risk through an ORSA process. And hopefully then we'll have some time at the end for any questions you have. So let me jump in. I just have a few slides, but a bit of material to go through in terms of COVID and the ORSA. Let me start, I guess, with a little, you're going to have to imagine, you have to bear with me for a minute. I want you to forget everything that you've learned in the last 18 to 24 months. And I want you to imagine that you are an actuary involved in preparing an ORSA for a health insurer. And you are back in, let's say, September 2019, and you've never heard of COVID-19. So if you have to close your eyes to get in the zone, you can do that. But I want you to imagine you're back then. I promise I won't put anything interesting up on the screen while your eyes are closed. So you're feeling proud. You've just completed the work on your ORSA, and it's been approved by the board, and you think you've done a good job thinking about the impacts of all the risks that insurers face. And one of the risks you thought about was a pandemic. So if you thought about a pandemic in your September 2019 ORSA, what sort of things did you think about? And you can open your eyes if you have them closed. I suspect nobody had their eyes closed. I can see you all. Nobody had your eyes closed. Okay, I'm going to guess that in your September 2019 ORSA, you would have talked about an increase in claims costs. So you're thinking about a pandemic, and you're going to say, I have a scenario where the temporary increase in claims costs, and maybe that's been supported by some analysis you've done of past pandemics and the impact on claims rates, perhaps with some geographical component to it. Okay, so now we're in September 2021. You're modeling a future pandemic in your ORSA today. What kind of additional factors might you consider? And obviously we've had some good insights from the previous presentation in terms of the potentially widespread impact of something like COVID-19. So we've seen that a pandemic on a large scale can be hugely disruptive to normal business patterns, and that can impact sales volumes. It can also impact things like customer behavior around lapse and around renewal. One of the things I suppose that maybe caught us a little by surprise with COVID-19 was the impact on investment markets. I guess in the past we might have thought a pandemic and investment markets wouldn't be so heavily correlated, but we've seen not just investment markets, but wider economic impacts. We've seen job losses, whole industry has been shut down, and quite a wide impact from COVID. Operational resilience has been a hot topic, and it's had a huge impact on lots of firms. We've almost all had to pivot to working from home. There's been increased pressure on IT infrastructure and increased pressure on workforces. While the pandemic has had a direct impact on claims costs, there's been a direct impact on hospital activity related sort of directly to the pandemic itself. There has been a slowdown in non-pandemic activity in most global health systems. And it's been very significant in many places, with many global insurers seeing material short-term reductions in claims activity. We've also seen material regional differences. So if you're an insurer with customers in many different markets, like an international private medical insurer, regional differences in infection rates, also regional differences in government or societal responses to the disease have given very different outcomes. So we've seen, quite a number of differences in terms of regulatory responses, and that's impacted firms in a number of ways. We've seen things like restrictions in some countries on the ability to pay dividends, for example. And then obviously vaccine timelines have had a major impact on the development of the disease, and it points to risks around the potential duration of pandemics connected to the timeline and efficacy of vaccines. We've also seen huge changes in delivery of service. Companies able to transform or transition to digital and telehealth solutions are being more successful. And obviously thinking about differences between the short and long-term impacts of the pandemic and the impact of long COVID, for example. has been a challenge. So I guess quite a range of impacts here. And maybe one last one from I'm sure there are many others, but one last one from an actuarial perspective is disruption to data. Data is the lifeblood of many health insurers, and it really does inform key central processes like pricing, like underwriting, like reserving. And a pandemic can materially disrupt normal patterns, and that can give rise to increased risks that prices or reserves won't be right. So really, I guess COVID has sort of taught us, I think, in the context of any risk, the level of complexity that can be there is quite staggering. Risks that we imagine as being, I guess, relatively straightforward to understand. There's a pandemic, it's likely to impact claims costs. In reality, you can see that they're potentially far more complex. Not only are there many moving parts and potential impacts, as we saw on the previous slide, but there's a huge level of interconnection between all of those. So I think one clear lesson is that the impacts of something like a pandemic can be felt right across the business, from sales to operations, from underwriting to human resources. And to me, this underpins the importance of involving a wide group of stakeholders in discussions of risks and ORSA scenarios. I think if you do that, you can then start to build a strong narrative around potential risk impacts informed by a wide range of views, and that can really inform strategy. And the ORSA can start to be a powerful framework for facilitating this. While the interactions are complex, the variables from a solvency and liquidity perspective, I think, are still manageable. So if you can start to build that narrative, involve the views of a wider group of stakeholders, you can then start to maybe translate it into a better sense of things like impacts on claims, investments, expenses, new business volumes, but maybe more importantly, the potential interactions between those variables. And that can make for a much more informed, I guess, a more informed scenario analysis. It allows you to make for better understanding of potential solvency and liquidity impacts. I think it also allows for more informed decisions around strategy and actions the company can take, not just to mitigate the risk, but maybe even to position itself to take advantage of opportunities. And I think that gives a sort of a good sense of maybe some of the lessons we can take from COVID and bring to complex risks in the ORSA more generally. So I guess these lessons are really focused on how an insurer can learn from the COVID experience when developing scenarios in future ORSAs. I guess there's also a key challenge for insurers to grapple with around the ORSA and wider risk management processes themselves. So in a pandemic or other complex risk situation, the picture changes almost daily. For an ORSA to be useful in informing strategy and overall solvency needs, I think it needs to be more dynamic. So the idea of sort of dusting down the ORSA, running a few scenarios and putting it away, that doesn't really fit very well with this kind of quickly changing environment. So I think for insurers to really get the full benefit from an ORSA, they need to invest in ORSA processes, allow a more real-time assessment of the impacts of moving key variables in the business plan, and they need to build the capacity to generate bespoke scenarios in real time. So I guess so far I've focused on how our experience through COVID can inform the ORSA more generally, and help us to think about things like pandemic risk and other complex risks in terms of, how do we address those more fully through the ORSA in future. And you might reasonably ask, well, that's all very well, but what about now? What do I do right now? I'm working on 2021 ORSA and COVID is still ongoing. And what are the things I need to be thinking about right now, specifically in relation to the potential impact of COVID over the next year, the next 3 to 5 years? So I think similar considerations probably apply. For me, there's an important piece here about gathering relevant stakeholders and trying to understand the narrative around what might happen from a COVID perspective and the impact that this might have on your company. You need to try to translate this into a range of potential impacts on key ORSA assumptions, And I think stakeholder perspectives will inform probably not just your sense of what's likely to happen, but the range of potential outcomes or the level of uncertainties, and give you a sense of, I think, what are the key scenarios worth investigating, the ones with meaningful combinations of interconnected assumptions. So I'm capturing here, I guess, some of the considerations on this slide. I don't intend to talk through all of these in any great detail, but I will try and pick out some that might be worth considering. I think when you're thinking through here, it isn't just about the best estimate, I guess. It's also about that variability. What are those range of outcomes? And as you start to pull some of the individual variables, I think as you build that narrative, you can get a sense of how they interconnect together and what scenarios become more meaningful for the insurer. So maybe just to focus on a couple of these, I think from a claims perspective, for health insurers, one challenge in many countries has been the reduction in non-COVID activity in the hospital system. I think as our previous speakers alluded to in the Q&A, there can be good reasons for this, reductions in other communicable diseases because of lockdowns. And we saw that, it was alluded to the reduction in flu in the Northern Hemisphere in last year's flu season. We've had lockdowns, we've had social distancing, we've had mask wearing and hand washing, and that's had an impact on non-COVID activity. But more broadly, the level of reduction in impact, and it's been right across the board in many cases, that may point to some pent-up demand. So for example, elective surgeries being postponed, and in addition, there may be longer-term implications. So I think health insurers will need to start thinking about, whether reductions in services like cancer screening and mental health supports, and in quite a number of other areas, whether those might have longer-term implications for health and well-being of the insured population, and potential implications for cost. We've talked about sales volumes, and I think understanding the potential impact on sales volumes over the next sort of 1 to 5 years is going to be challenging too. The market has become quite disrupted, and how has that dynamic changed since COVID? What have your competitors done? What have you done to react to changing circumstances? Have some companies engaged better with customers, pivoted product offerings to reflect changing demand for telehealth or digital services, for example? And how have companies dealt with situations where people have been paying premiums with reduced potential to claim, for example? Companies with lots of corporate business, how does the wider macroeconomic environment, what implications does that have for employment levels? We feel there may be pent-up demand for employee mobility, which could have implications for workforces. Have companies reduced activity like rebroking insurance schemes during COVID, and will there be an increase in activity if and when we get back to normal? So I think in some countries, employment levels have been maintained by government support payments, and again, questions around whether this will lead to reductions in scheme memberships if and when government supports fall away. So I think overall COVID leads to a complex situation with implications right across the business in a rapidly changing environment. This raises lots of challenges for insurers preparing for ORSAs. I think the challenge I alluded to on the previous slide, are insurance companies' ORSAs dynamic enough to allow for the speed at which the environment changes, and are the scenarios sufficient, I guess, to reflect that overall level of uncertainty? I do mention regulatory expectations here, and these can vary by jurisdiction, but broadly, I think similar key themes are emerging. EIOPA issued a supervisory statement on the topic of COVID in the ORSA in June, and it covers similar themes to what I've identified here. EIOPA expects insurers to assess the level of uncertainty around areas like claims development, premium volumes, liquidity, and also capital impacts, and to document any material sources and levels of uncertainty, and consider multiple scenarios to capture the uncertainty appropriately. So a lot to think about there in terms of anyone preparing an ORSA, and just when you thought that the ORSA was the biggest risk you're likely to face for the next while, I'm going to hand you off to Sinead, who's going to scare you with a discussion of climate risk. So over to you, Sinead.
Thanks, Kevin. I'm just going to try and take control of the slides.
Good.
Okay. Good morning, everyone. So as Kevin mentioned, or good afternoon, everyone, it's morning here for us. Kevin mentioned I'm going to talk about climate risk and the requirements for ORSA. Let's see. Okay. So first things first, what is climate-related risk? So there's lots of different risk exposures associated with climate risk, but recently industry has tended to categorizing them under these two headings, physical risk and transition risk. So physical risks are the risks associated with the direct impacts of climate change, and they can be further subdivided into two categories, acute and chronic. Acute physical risks are event-driven, and they include catastrophic weather events. They're the type of risks that, the type of CAT risks or events that non-life actuaries have a lot of experience modeling. So for example, the floods in China or Germany a few months ago. Climate change might impact the severity or frequency of these type of events in the future. And that could lead to increased hospitalizations and higher claims for health insurers. Chronic risks then are more longer term, and they're caused by the impact of long-term shifts in climate patterns, such as sustained higher temperatures or rising sea levels. There's more uncertainty here as we're looking further out into the future. And from a health insurance perspective, this could mean higher incidence of vector-borne disease, more epidemics or pandemics, and this can impact loss ratios and underwriting, amongst other things. So transition risks then are the risks associated with a transition to a low carbon, greener economy. And this can impact asset values and other costs associated with the supply chain. There's uncertainty associated with what this transition might look like. And there's different risks associated with an orderly transition that could occur over a long period of time compared to a knee-jerk or unorderly transition, or no transition at all. Generally, we would expect transition risks to be higher if action is taken over the short to medium term to combat climate change, with lower potential physical risk in the future. However, if action isn't taken soon enough or no transition occurs, we would expect more physical risk to manifest in the future. So why is climate risk different? Well, first of all, we can't look at the past data to inform the future. As actuaries, we're used to looking at the past to set assumptions about the future, and this is a little bit outside our comfort zone. There's also a high level of uncertainty associated with the probability and impact of future events. And this means that there's a wide variety in potential future economic outcomes. And these could be driven by political decisions, which can be difficult to predict. Climate change is also an emerging risk and best practices developing. So this means that risk exposures and risk appetite mightn't line up initially, and it might take some time to reduce climate risk exposure. This also means that a lot of the conversation around climate risk management is about insurers taking the first step to understand this, and perhaps a more simplistic approach can be used initially. And finally, time horizons matter. So in the ORSA, we're used to looking over the business planning time horizon, which typically is 3 to 5 years. But for climate-related risk, we need to look out over different time horizons to reflect the long-term nature of climate risks. But there's also the possibility of things changing fast. So consumer sentiment or the political landscape could change. And this could happen over the short term. From a health insurer's perspective, where products are generally sold over a 1-year time horizon, longer term scenarios might be difficult to model and project. Okay. So in relation to what is required in the ORSA in respect of climate risk, the answer is that in general, companies in Europe aren't doing a lot just yet. EIOPA issued its opinion on the supervision of climate change scenarios in the ORSA in April of this year. The opinion is written to the supervisors, so the regulators and central banks, and it's set out in terms of what the regulators should be expecting from insurers in their territories. EIOPA will begin to monitor regulatory compliance with the opinion from April 2023. So the next step in many countries is for the regulators to issue advice to insurers in respect of what they expect. In Ireland, the Central Bank of Ireland is our prudential regulator, and they have said that they will issue an opinion on this in the coming months. In the UK, although it's not part of the European Union anymore following Brexit, things are a little bit more advanced. And the prudential regulator there expects companies to fully integrate climate-related risks into the risk management process by end 2021, and to start to make climate-related financial disclosures in 2022. France and some other countries, including the UK, have also begun to ask companies to take part in climate-related stress tests. So a lot of focus on the EIOPA opinion has been in relation to stress and scenario testing, and the title also focuses on that. However, the opinion also asks regulators to ensure that companies have integrated climate change risks into their system of governance and their risk management framework. And for me, this is the first step. It's not really possible to determine suitable scenarios without having initially assessed and measured your climate risk exposure. So considering your exposure relative to risk appetite. So companies will first need to work through the normal risk management process to understand their climate risk exposures before determining what scenarios to run. And it's important to note that while climate-related risk itself might be new for an insurance company, the risk management process that you go through is the same as for any other risk. So EIOPA has also asked companies to assess their climate risk exposures in the short term. And many companies have started to do this qualitatively in their 2020 ORSAs in Ireland at a high level. But the ORSA opinion will require companies to do this qualitatively and quantitatively. So for example, if your company does not think that it has material climate risk exposure, you'll need to justify this, and you'll need to justify this using numbers. This can generally be carried out as part of the normal ORSA stress and scenario testing over the business planning period. And some impacts of climate-related risk, be they physical or transitional, will overlap with stress and scenarios that you're already considering in your ORSA process. So transition risk might overlap with some market risk stresses, and physical risk might overlap with some catastrophe risk stresses or higher claims, higher loss ratio scenarios. But as I'll explain on my next slide, the full impact of climate risk might not be that simplistic. And then finally, EIOPA has asked regulators to ensure companies are assessing material long-term risks of climate change using forward-looking scenario analysis. So EIOPA has noted that from a climate risk perspective, the long term could be 30, 50, 80 years. And that can be quite daunting for an insurer's perspective to predict a model with any level of accuracy. But EIOPA has acknowledged this, and it does expect that companies will use proportional or high-level approaches, at least initially. And I think a key word here is the word material. So these scenarios are only required for material climate-related risks. So EIOPA has outlined two scenarios that should be considered. One scenario where global temperatures do not increase by more than 2 degrees Celsius, and preferably no more than 1.5 degrees Celsius, which is in line with the EU commitments. And a second scenario where global temperatures increase by more than 2 degrees Celsius. Now, it can be difficult for insurers to translate what this means. What might a 1.5 degree increase in global temperatures impact your balance sheet or your business model? And how might this differ if the increase is 2 degrees? There's lots of sources available online projecting what the macroeconomic impact of these changes in temperatures might be in terms of impacts on GDP, interest rates, inflation, etc. But again, that can be difficult to translate into the impact on a specific insurer's balance sheet or business model. A simpler way to look at it is that in order for an increase in global temperatures to remain below 2 degrees, action will be required now. And policy and regulations will need to change quickly. And this is likely to lead to increased transition risk in the short to medium term. So the first scenario could be one where there's more transition risk and more market volatility and potentially less physical risk as a result. But if action isn't taken quick enough or a transition to a low carbon economy doesn't occur at all, then global temperatures are likely to increase by more than 2 degrees. And in this case, it's expected that there'll be a lot more extreme weather events and a lot more unknowns in terms of physical risk due to long-term shifts in climate patterns. And this could be seen as a scenario then where there's greater physical risk. If you think about these scenarios in this way, it makes it a little bit easier to build a narrative on what the impacts could be for your business. EIOPA has also provided a useful annex in the opinion, which can be used to map climate-related risks to potential risks. And it therefore provides insurers with a good starting point on how climate-related risk could impact their business. So I've pulled out some examples for health insurers here. So for transition risk, the first box in green highlights market risk impacts that are driven by transition risk drivers. So for example, a policy or regulation change in relation to carbon taxes could adversely affect the value of carbon intensive assets. This means that corporate bonds or equity investments with companies in energy intensive sectors could fall in value. And energy intensive sectors includes investments in electricity or utilities, transportation, agriculture, building and fossil fuels, amongst other things. The value of these assets could fall, and in a worst case scenario, the assets could become stranded and the insurer might not be able to dispose of them. That could impact the balance sheet in the same way as any other market risk. Late government action in terms of transition, which is sometimes called a disorderly transition, could result in more volatility than an orderly transition and even an increased market risk as a result. So we normally associate transition risk with market risk. However, there are other impacts too. And I've included some strategic implications on this slide, such as could impact sales volumes. You'll see them in the blue box. So for example, if a large portion of your customer base is based in carbon intensive industries, this could have real strategic implications for your company. So let's consider an extreme example. Perhaps there's a health insurer that has a very good reputation for providing health insurance to employees of oil companies or employees seconded to oil rigs. Maybe they offer really good ancillary assistance benefits to help win this customer base. What happens if demand for oil reduces as we move to a low carbon economy and therefore there's less employees in the sector? How would you replace this customer base? And what if consumer sentiment or societal preferences change very quickly? Other customers might be put off by the fact that you market or insure to employees of oil rigs. Consumer demand for insurance products could fall if insurers don't adequately allow for sustainability factors like this. And the risk could increase if a competitor launches a new green product. From a health insurer's perspective, though, a lot of the things that insurers are trying to achieve in terms of efficiency and reductions in healthcare waste and unnecessary procedures actually have a lot in common with sustainability goals. And I think we'll see a lot more health insurers making this link in terms of marketing to a greener customer base in the future. And this could reduce some of the risks associated with transition risk for these insurers. In terms of physical risk, I've split them up between the risks driven by acute and chronic physical risk in this slide, but underwriting risk can be driven by both acute and chronic physical risk. Loss ratios will be more volatile if there's more extreme weather events or if there's greater risk of epidemics and pandemics in the future and increased risk of infectious disease. But while we generally think about physical risk impacting our claims and loss ratios, there could be other impacts too. So for example, counterparty risk might increase. So I've mentioned counterparty risk associated with reinsurers here. If a reinsurer is exposed to high claims from extreme weather events or litigation in respect of climate change, this could impact their credit rating and probability of default. Counterparty risk might also increase in relation to government bonds if specific countries are more exposed to the physical impacts of climate change. And then there's also operational risk associated with physical impacts of climate change, and the costs of doing business might increase. Rising waters, crop shortages, etc., could impact the supply chain in unexpected ways. Or we could see more lockdowns in the future if pandemics are more frequent. So while this mapping from EIOPA is very useful and it's a very good starting point for insurers to consider climate-related risk, it does look at each risk in isolation and it puts the risk into various potential risk boxes depending on whether it's driven by transition or physical risk. And I suppose from what we've learned from COVID-19 is what Kevin mentioned earlier is that it's just not that simple. COVID-19 impacted lots of aspects of health insurers' business at the same time. And actually, the impact on loss ratios, at least initially, was probably the opposite to what we would have expected before the pandemic. So key learning that we should take from COVID-19 is that these risks are much more connected than we think. And climate-related risk will hit the various aspects of a health insurer's business and balance sheet at the same time. So in terms of looking at how to allow for these in the ORSA, the focus should be on scenarios where a couple of things happen at the same time, rather than simply stress testing one risk at a time. In a way, the two broad scenarios prescribed by EIOPA in relation to assessing the material long-term risks are probably trying to achieve this. There's one scenario looking at transition risk and one looking at increased physical risk. Companies should consider these two scenarios holistically, both in relation to the long-term scenario testing, but also when looking to understand climate risk exposures over the short term. And as Kevin mentioned earlier, we should involve stakeholders from all business units in order to build out relevant climate risk scenarios and narratives. Transition risk is not just market risk, and physical risk is not just underwriting risk. In taking this holistic approach, we should be able to learn more about the potential risk that climate change poses to health insurers. And more importantly, health insurers should be able to take action to mitigate against these risks and also to understand where any opportunities lie. So before I hand over to open up the Q&A, I promised Kevin that I would plug the IAAHS Health Risk and Risk Capital Project team. So we're looking for volunteers. Please contact Kevin if you're interested in getting involved in the group. It's a great way to network and meet other actuaries from around the world who are working in similar areas to you. And with that, I'll hand over to the moderator for Q&A.
Right. Thanks, Kevin and Sinead, for the insightful sharing on COVID and ORSA. So I guess before we proceed to the Q&A, I'd like to just remind the audience again that if you have any questions for the speakers, you may actually do so using the Q&A function in Zoom. And also do upvote the questions that you want to be answered. So I'll get to them in order of popularity. Right. So for the Q&A, so I think there's one question from KK and it's directed to Kevin. So Kevin, so in your opinion, what are the key risks that are particular evidence during the COVID period, which can also be a good candidate for reassessment of stress for future ORSA? This can be beyond the stressing of incidents and financial impact. Right.
Oh, you're on mute, Kevin.
Thanks, Sinead. That's by law, somebody has to be on mute when they're speaking on a presentation. So yeah, I guess key risks and vulnerabilities that were particularly evident during the COVID period, good candidates for reassessment or stress during future ORSAs. I mean, I guess I touched on quite a number of impacts that COVID had. I mean, when you think about the risks, I guess that an insurance company faces, they manifest themselves in lots of ways, but through reductions in sales volumes, impact on customer renewals, certainly loss ratios and others. I think one of the things that probably struck a number of companies was phenomenal change in the business model, people working from home, quite a shift towards telehealth and digital. And I think what's happened a little is a customer base that probably hadn't fully embraced some of those technologies has moved a lot more towards that. I think there was always a sense that the younger customers were moving more towards digital. I'm not sure that that was sort of more broadly felt. Whereas now I think everybody's gotten comfortable with Zoom calls and Teams meetings and so on. And I think that could lead to a fundamental shift in delivery of healthcare. I think insurers that have pivoted towards that will have better success, I guess, in terms of competitive advantage. So maybe that's something that we'll start to see come through. I think there's a risk to companies that haven't been able to pivot in the same way that will need to be considered. Not sure if that really answers the question.
Right, thanks, Kevin. So we have another question from Mr. Chi. So should actually start discussing with epidemiologists to have more knowledge about epidemics and pandemics so that they can test more scenarios? So COVID-19 took a certain pathway, which can be deviate from the other diseases, like Ebola pandemics, especially malaria pandemic in Europe. So do you have any comments on that?
Yeah, I think that's a great question, and it's certainly something. So I work with Milliman, which is an international consultancy, and one of the things we did in Milliman is engage an epidemiologist to work with us and to share insights. And I think it comes back to that kind of question about, which I mentioned earlier, about bringing in wider stakeholder views. Now, we did it primarily in the context of COVID, but I guess the question is sort of alluding to looking forward to pandemic risk more generally. Is this something that we should be doing? And I do think the point about engaging with wider stakeholders and bringing in wider stakeholder views is an important one. I think we have to acknowledge, we have a skill set and a knowledge base, which is great in lots of respects for understanding the business that we're involved in and how that might change. But there's a vast world of knowledge and insight that we don't have. And I think bringing in those wider stakeholder views will really help to sort of make our own analysis better going forward. So absolutely agree 100% with the direction of that question.
Right, thanks again, Kevin. So another question is regarding the, I guess, should IA actually issue guidance for actuaries on the incorporation of climate risk into ORSA and the other risk management functions?
I think that's probably one for me. So what we've seen generally in terms of guidance, in terms of how to bring climate related risks into the ORSA, is that it's been quite high level. So the EIOPA guidance focused on those two scenarios for long-term risks, and some of the scenarios that we've seen from other groups and including in the PRA kind of focus on those type of scenarios as well. So one where there's more transition risk and one where there's more physical risk, and sometimes the transition risk scenario is split out into one where there's an orderly transition or one where there's a very disorderly transition at a later date. But there hasn't been a huge amount of guidance then in terms of how you translate those scenarios to your balance sheet. And I think part of the reason that is because the regulators want companies to assess their own exposures. And if the regulators provided a very prescriptive scenario in terms of shock equities by X%, shock corporate bonds by Y%, then that wouldn't, I think, achieve the same aims in terms of getting companies to assess their own risk exposures. And I understand that that's probably an area where companies are struggling with. But the first step, I think, is to look at your own balance sheet and understand where your potential climate risk exposures lie, and then to build out a scenario, climate risk narrative and scenario test from that, rather than regulators providing guidance on what that stress could be, because it's not going to be the same for all insurers.
Right. Can I just jump in with just a short comment on that, I guess, and maybe this is a plug for the IIHS project team too. I do think actuaries getting together, to, whether it's through the IAA or the SAS or your local actuarial society, sharing views on topics like these and how to allow for something like climate risk in the ORSA or in risk management more generally. It is a way of developing good practice, and maybe it's a stepping stone towards ultimately getting to potentially guidance that could be useful for all actuaries. So if it is an area that people have an interest in, the project team would be a good way of, I suppose, building towards a view of what is good practice for allowing for something like climate risk in an ORSA and the risk management system, which I think then could help us bring some guidance together that will help actuaries, I guess, sort of take best practice into account or understand what's happening in other companies.
Right. So Mr. Shi has actually a follow-up question. So like he mentioned that the IA guidelines should not be prescriptive, but ensure that actuaries take all relevant information into consideration. Yeah. But I think I'm not seeing any more questions. So I guess we can end here.